Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Thank you for joining me for another one of my portfolio updates. I haven't done one of these since September, so I thought it'd be a good time to do one and talk about some of the struggles growth stocks have seen in recent months. If you just look at the NASDAQ, the correction hasn't been all that apparent, but some of the underlying names that aren't Apple or Microsoft or whatever that has been holding up the NASDAQ have struggled a lot, especially if you're one to buy in recent times. I have Roku up here. I'll talk about that. I also have PayPal that I want to talk about and some other stocks, because if we look at the 1 month returns here in my various slices that M1 allows you to make, fintech has really struggled here. It's down 15%, whereas everything else is either up or flat. I did make some updates to this portfolio, and I mentioned those in my spreadsheet. I'll link that in the description down below, but I kind of keep track of what I'm doing just so you guys know exactly where I am in my portfolios and you can follow my moves. So on 10/29/21, I reduced fintech to 14% and raised autonomous vehicles to 5%. I just saw some weakness in fintech. I was worried about some of the earnings that were coming out, and obviously in the latest month, those have come to fruition. Now, this didn't really impact my portfolio much because fintech was already underweight. It was 15% before, now it's 14%. So I just didn't want to buy too much when I thought there was weakness ahead. And luckily in this case, I was right. You know, it's anytime you're doing active trading, you're kind of guessing. But I felt like some of the valuations there were overextended. And if some weakness was shown on earnings, those would fall quite a bit. And even in strength, some of them fell quite a bit. Something like C Limited, which I thought had really good earnings, dumped after earnings quite a bit. So I was pretty happy about that. And you can see that on 11/17, I removed Stone Company from my fintech pie. The earnings were just terrible. I thought the credit struggles there were kind of beyond my understanding because I'm not that familiar with the South American market there. So I kind of moved away from that. It was a very small position at, I think, 3% of my fintech pie. And I increased my C Limited holdings to 9% in that pie based on the amazing earnings. And I also made some changes. I reduced Visa a little bit. I raised ICE a little bit. Visa had some issues with Amazon basically saying, hey, we're not going to take your card anymore. So I think there's going to be problems for some of the credit card companies in the future, especially with all of these, buy now, pay later companies trying to take a bite out of their business, and all of these new fintech players like SoFi moving into a variety of spaces that are going to make fintech a competitive landscape. And I think that's why some of these valuations are resetting. So if we go back to the fintech pie, I'm not really going to focus on everything else because everything else has done pretty well. I think in the near term, most of my purchases here, and I think I'm going to start putting more money into the growth pie again. I mentioned last time that I really wasn't buying a lot of growth simply because the valuations were overextended. Well, now in a way they've corrected. If we look at fintech over here in the last month, Square is down 17%, PayPal is down 22%, C Limited is down 19%. So I kind of want to buy more C Limited. I kind of want to buy more PayPal. I kind of want to buy more Square. I think I'm in a good spot there. If we look at PayPal, I really want to talk about that now since it's a good segue. People probably wonder, well, what the hell is happening here, right? This is a stock that was at $300. It's down to 188. You know, if we look at the last 3 months, it's down 31% in the last 3 months. And that's a pretty big haircut on a company as mature as PayPal, right? This isn't some no-name growth stock. They've been around for a while. They're a free cash flow machine. The problem is that if you look at their financials and their latest earnings, if we look at quarterly earnings over here, and kind of make it slightly smaller so we can see the last couple of months, there's been some slowing growth. You know, these stocks, and this isn't just PayPal, this is a lot of these growth names. Peloton is another, Roku is another, that really benefited from the pandemic and the stay-at-home market and the online shopping market. Fintech companies certainly benefited from that. They saw growth that was far better than their historical averages, anywhere from, 11 to 23% for PayPal. Suddenly they were growing at 30% for a couple of quarters. And the market kind of looked at that and said, hey, maybe this is the future. Maybe this is how it's going to be going forward. So if you look at their valuations going back to pre-pandemic times, they were essentially in the 6 to 7x range on forward multiples, 6 to 8 range on trailing multiples. And suddenly once the pandemic kicked off, once you saw that uptick in growth names post the pandemic, these things skyrocketed to 10, 11, 12, 14x a couple of months ago, right? So you're looking at 14x trailing multiples, 12x trailing multiples versus 6 to 7x in the past couple of years pre-pandemic. Then you go back to the financials and suddenly the earnings are coming in at 13% versus 25 to 30%, and people are saying, "Wait a minute. So this is more in line with what it used to be than what it was for the couple of months where the pandemic was in full effect and lockdowns were in place." And we're seeing a re-evaluation of these stocks back to their historical norms. And that's kind of what's happening in some of these growth names right now. If you look at PayPal today, now that it's down 30%, it's back to an 8x trailing multiple, 8 to 9x. Still higher than it was in the past. It peaked at about 8x here. Their forward multiples are at 7.6, 7x here. So certainly the valuation is coming down to a point where it's fairly valued in relation to their historical norms and the growth they achieved back then, right? So the idea here is, hey, the stock price basically ran away into an unreasonable territory. So if you look at my PayPal acquisition costs when I was actually buying PayPal, and that's what I really like about M1 Finance, is because of the way the pies work. They allow you to buy pies that are underweight, and once they get overweight, which fintech did for a while because of how aggressively priced these stocks were, I wasn't buying any PayPal. So my buy-in price is $163. So I'm still profitable on PayPal despite the stock dropping 40%, right? And I think this is a fair value of it. Like $163 when I was buying is probably the fair value right now, because if you think about it, if it falls a bit more, it'll kind of go back to the 7.9x valuation that it was in the past. And that's what you should be paying for a stock like this, right? That's kind of the same story with Peloton and Roku, etc. These guys had accelerated growth, and because of that accelerated growth, these stocks saw their valuation soar for a couple of months, and now that their earnings aren't as amazing as people thought they should be, those valuations are getting reset a bit. So if a stock is dropping 30 to 40%, even if it's a big name like PayPal, doesn't mean it's a crap company. It just means that the valuations are being normalized to what their earnings are right now. Because I still think PayPal is a great company, right? There's certainly risk ahead, but there's also potential, right? There's risk ahead in the form of other companies like Aiden, Square, the buy now, pay later companies, all of the fintech companies that are moving into this space, because they're going to be competing for the same piece of the pie. Now, the good thing is that the pie is pretty large, and PayPal is in a position where they have 430 million Venmo accounts that they can utilize in other ways. They recently purchased Paydi, which is a buy now, pay later company. I think they purchased Paydi. They purchased Honey, which is a coupon place. And I think what they're going to try to do with that, and what I'm hopeful they're going to try to do, is kind of make a one-shop app that includes all of that stuff embedded into it, right? So you can go on there, you can have the buy now, pay later feature embedded, you can have all of the online coupons automatically applied wherever you shop. They've also developed they've got a deal with Amazon that Venmo is going to be embedded on the Amazon page starting in 2022. So there's some upside here. And again, this isn't some no-name company. This is a company that's generating $6-7 billion in free cash flow. They have a very good balance sheet. Once these valuations reset on some of these other fintech companies, which all of them are getting hit right now, they can probably buy something else. If we look at their balance sheet, they have almost $13 billion in cash, $7-8 billion in long-term debt. So they're flush with cash, no balance sheet issues. They're producing cash flow. Still a good company. It's just that the valuation ran away from them, right? So as I look at my portfolio today, based on my targets here, I have a 14% fintech target. The next couple of $100 that I'm going to pump into this are probably going to go into this company. And I'm okay with that, right? I'm okay with PayPal correcting even more because I know that it's going to get to a price point that I'm willing to buy it at. So if I look at some of my other holdings, right, even Square, which fell quite a bit. Let's arrange it by. So Mercado Libre fell quite a bit. It's down to like $1,300. My average price is $790, right? I haven't been buying a lot of it because of the way this works and the fact that I haven't been putting a lot of money into growth. But now that these prices are falling back to earth, I'm in a spot where I'm liking what I'm seeing, and I'm going to start putting more money into some of these corporations, right? And I don't think they're done correcting. and they're not just correcting for the fact that some of these valuations got overextended, but inflation's also up. And with inflation, there comes the fear that interest rates will be raised. And as interest rates get raised, valuations also get reset across the board, not just in growth stocks. Their companies have to pay more for their debt if they want to issue more debt. Bonds start becoming more attractive than they have been if yields start rising above what the stock market is offering, and the stock market is offering 2 to 3% at this point. If yields start rising above that in the near term because the Fed is trying to combat inflation, that's going to impact some of these stocks. And I wouldn't be surprised if that happens. And if that does happen, you're going to be seeing a big reduction in some of these valuations below what they have been in the last year or so. And right now that's hitting the fintech stocks, but it's also going to hit some of these other plays, right? I'm up 300% on NVIDIA. I'm up 100% on a lot of these plays. If you look at all of these unrealized gains, pretty much everything is like 50% plus. And that's impressive, but it also shows you how far these stocks have gone, because the reality is that their earnings have not gone up 50% plus or anywhere close to that for the majority of these corporations. For some, they have, mainly those that haven't been making any money yet. But for a lot of them, it's just the expansion of their multiples that's driven this price appreciation. And while that's a good thing, the risk that comes with that is that at some point, these multiples can and probably will shrink. And once they do, these prices will fall. So the reason I haven't been putting a ton of extra new money into this portfolio is that these multiples have gotten away from me in terms of what I feel comfortable paying for some of these companies. And while I put some money here and there, it hasn't been a lot. Most of my money has been going into these dividend aristocrat stocks, which in the last month have actually done better than the other players, right? There's still not a great return because these are kind of slow and steady players, but they're throwing off dividends and people are trying to move into safer plays. And these safer plays are dividend payers, value stocks, companies that have been around forever, companies that have paid dividends through thick and thin, which is what the dividend aristocrats have done. These are companies that have paid dividends for 25 plus years. So if there's a correction up ahead, if there's stagflation, if there's high inflation, the hope is that these stocks will do better than some of those other ones as multiples correct, because the multiples here are fine. You're not paying 30x sales for companies in this portfolio. For some of them, you're paying like 1x sales, right? And that's certainly a much better spot to be in if there's a fear of raises on the side of the Fed. So if that's going to happen, you certainly want to be in a spot where the multiples you're paying are a lot lower than paying for stocks that are 30x at this point, because that 30x can easily become 15x, whereas a 1x probably won't become half x. It might fall, but it might fall less because people are going to seek safety in those situations. If there's a correction, if there's I don't want to say a depression, but if there's a recession of any sort, at the end of the day, 2008 was the last major crisis. Certainly in 2020, we had a small market crash. And when I say crisis, I mean market-related crisis. In 2020, we had a small market crash, but the recovery was swift and not all that painful for most, right? It came and it went straight to the top, right? These valuations expanded, they doubled overnight, and we find ourselves in a spot where those valuations are now coming back down to earth, and that's hitting the growth stocks more than that's hitting the dividend aristocrats. So if we look at my portfolio here, the returns since the last update, the growth stocks are up 2%, still up, despite the fact that PayPal in that portfolio is down like 30% since then. But that's, again, a small piece of the pie. That's why having 59 stocks and being diversified is nice, because Apple still went up, Microsoft still went up, Amazon still went up. So even though 10 stocks might have fallen a ton, a lot of those other stocks really buffered that fall. And then the aristocrats are actually up 6%, which is higher than the S&P 500, because people are seeking safety over growth right now, because growth is suddenly looking a bit more risky in the face of what's coming up. If inflation's coming up, if a recession is coming up, if rising rates are coming up, growth is going to struggle. Aristocrats may struggle as well, but they'll struggle less. So at the end of the day, because the growth really trailed the S&P 500, this update, I was lagging the S&P 500. So my return was 3.8%. The S&P 500 was a bit over 5%. Still, since the beginning here, because of how growth has done, I'm up $8,000 off the same portfolio. I did find an error in the way I calculated the S&P 500 returns, so they were lower in the video. They were lower than what I showed in the last video, but that's gone now. That's fixed. So still good returns here, trailing the S&P 500 this update, but overall still in a good spot. Again, the growth portfolio is there because of what it can offer, right? In the long run, growth is going to probably outperform value in the long run, but based on today's valuations, I find that hard to believe. I think growth is still extended. Again, if rates don't change in the next 10 years, growth will continue doing well, but there's risk of those changing. And I think that risk is greater now than it used to be in the past because of where inflation is. So overall, portfolio is still doing well. You can look at my dividends by month. I don't really track these, but again, half the portfolio is in dividend payers. So clearly the greens are outperforming the yellows. I have been putting a bit more money into this portfolio versus the growth portfolio. So overall, more money flowing into there. Probably going to continue for a bit more because I just feel that growth is still overextended. But due to the fact that if you look at my growth portfolio, fintech is underweight. Most of my new money will flow into fintech. I feel much better about fintech now than I felt about it a month ago when I made that change to reduce it. I'll still keep it reduced because I'm still 1.5% below my target. But I'll probably put a bit more money here to kind of buy up some PayPal, buy up some Square, definitely buy up some C Limited. Maybe I'll go in here and play with these numbers a bit. I'm kind of liking C Limited at these valuations more than I'm liking MasterCard and Visa because I think there's some roadblocks up ahead for these companies. They're not going anywhere, but they're already, their market caps are already pretty high, and I think there's potentially a bit more pain ahead there. So I'm not sure I want to still be buying at these prices. If they fall a bit more, maybe I'll get back on that horse. But right now, I wouldn't be buying much anyway because Visa's overweight because of that change I made, and MasterCard's just a little bit underweight. So most of my new money would go into PayPal, Square, C Limited, and maybe Fiserv, and I guess ICE. So overall, no complaints about this update. Still doing well. Clearly some concerns on the growth side here, but that's what's to be expected with growth. You can kind of see what's happened in this portfolio. In the last year, it hasn't done amazingly well, but in the year before that, you kind of saw the dip here in March. It's basically exploded. 200% return to here, 200% return here, 150% return here, 300% here, 230% here. Still, these are money-weighted returns, so they're probably slightly lower than that. I just don't like the way M1 Finance calculates that. Besides that, I love everything about the platform simply because it allows me to kind of put money where the struggles lie. And right now, the struggles are in the fintech side, even on the random industry side. If you look at some of my holdings that are negative right now, Roku's one of them, right? It's down 30% since I bought it. Activision Blizzard is another one of them. Fire the damn CEO already, Jesus Christ. But if you look at Roku, I think it's another good company to look at. If you look at their growth, it's still solid. I'm still liking what I'm seeing here, and their business model is one that I really like, especially their expansion into content a little bit, and their advertising model is there. They're still growing at 50%, but obviously that growth is slowing. You saw 70-80% growth down to 50% in this quarter, so some slowing growth, and then some margin compression on the hardware side. And you've seen that valuation really come down back to earth, right? You went from an 11x multiple pre-pandemic all the way up to 25x, and now it's back down to 11x. So at 11x, I'm liking this stock, right? So that's why I started a small position. I only have $300 into this, or $200 really now, because it's dropped 30%, and I'm probably going to buy a bit more now. So I'm in a spot where Roku starts looking good again. It wasn't really looking good here. I think I probably started my position somewhere around here, which was obviously dumb in hindsight because of the valuations, but I kind of expected the growth to continue on the pattern it was. Now that it's slowed, I totally understand the reset in valuation, and I wouldn't be super surprised if it drops a bit more. Now, the concern with Roku for me and why it's not a massive position is that I don't know how much clout they have in their negotiations, right? I really love their OS, and I use Roku on a daily basis, and I wouldn't change it for the world. But the problem is, if Netflix comes to them, I don't know when their next Netflix negotiation is, and says, hey, we're going to need you to take half of the cut you take for new subscribers. Are they going to be like, no, screw off and lose Netflix? Probably not, right? So I'm glad that they're kind of expanding that content space. They have the Roku channel, which has a lot of viewers. They've bought some content, This Old House and stuff like that. Not not anything marquee, even though that show's great. But I think it's going to drive people into their platform and even people outside their platform onto their channel, which allows them to sell targeted advertising, which is really what people are looking for because of the changes to some of the advertising on the internet that's limiting the value of that advertising on places like Facebook or any apps that are used on Apple devices, right? If you can get targeted advertising via Roku, that's really getting you the most bang for your buck over what you see on Facebook or over what you see on Apple devices. Clearly, the opportunity is there, and I think Roku is set up in a really good spot to benefit from that. So even though this valuation is maybe high based on where they're going in the future and slowing growth, it's still pretty good in relation to historical pre-pandemic times. And back then, their growth was slower than it was now. So they've actually picked up growth as they've grown, which is always an impressive thing to see. And I think they can continue to do that for a bit. I think they've got really solid management that is going to execute well. And at this price point and at this valuation, it's looking a lot more attractive again. So there's some spots in the growth space that are interesting for me, and I'll be targeting those spots right now. But a good portion of my money is still probably going to go into these dividend stocks because they're just safer right now, and I think this is a good time to be safe. Certainly easy to say that now after things have fallen 40%, but it's possible that they fall more, right? We've only started to see potentially, and again, this is all my opinion. I'm not a qualified financial advisor. Please do your own diligence and talk to a qualified financial advisor before you make any investments. If inflation continues and the Fed is forced to raise rates to combat it, this is probably just the beginning. If it's transitory, as some are saying, and rates remain low, despite the fact that we're pumping a lot more money into the economy via some of these new bills, then these growth stocks will continue shining like the bright star they have been for the last year or so. But nobody knows the future. So for now, I'll do what I think is best. I'll target the things that I think have a good valuation, because if that happens, then the things that now have a good valuation will probably expand again. And even if the others expand more, I won't have missed out too much. And if it doesn't happen, then I still think from a long-term perspective, the ones that have a good valuation today, based on their historical valuations, will do well 5 to 10 years from now. Some of these others may struggle, and I'll be able to pick them up at a lower price. And I think there'll be a flight for safety, and these dividend aristocrat stocks will also benefit from that. So I think it's a win-win situation, but it also shows the benefit of having two different portfolios and not being fully embedded into, let's say, growth stocks, right? Because when stuff like this does happen, when the market turns around a bit and growth suffers, if I was fully in fintech, I'd have lost 30% of my portfolio in the span of a month. That'd be tough. But since that's only a small portion of my portfolio, and I also have these dividend stocks on the back end to kind of buoy when growth falters, I think that's a good thing to be in. That's a good spot to be in, and why I invest the way I do. Again, you can do your own thing, but this is my style of investing. And also, this is a small portion of my portfolio. Most of my money is in index funds. That's kind of the investor I am. 80% of my money is in index funds. The other 20% is in active portfolios like this one. This is just a small portfolio that I like to share with you guys, and will continue to share throughout time here. Hopefully you enjoyed the video. Let me know what you guys think about this update. Let me know what you guys think about Roku, PayPal, any of the stocks I talked about. Obviously, I'm long Roku, PayPal, long SE, along Square, along all of the stocks in my portfolio. You can see the portfolios here. There are links to them. You can click here on the portfolio move sheet. I update this as often as I make any changes. And I also update the portfolio links when I do make those changes. So make sure to check those out if you're following along, because I will not do these updates every week. There's just not enough info happening every week. I'll probably do more videos about things like PayPal and Roku and just stock analysis type of things, but portfolio updates probably happen every 2 months or so. So come back, hit the like button if you like this video. I really appreciate that. Subscribe and all that good stuff. Hope you enjoyed the video. Have a good holiday and have a good rest of your day.